Hey everyone, and welcome back to the Teaching Tax Flow podcast, episode 123 today, the famous 123. We are continuing our ACE series, part 2 of 3, as we look at Schedule C. So before we do that, as always, let's take a brief moment and thank our episode sponsor.
This podcast is sponsored by Reps Tracker. Are you a real estate investor who is bogged down with the huge tax burden? Real estate investing can open the door to powerful tax benefits. Reps Tracker can streamline the process of accelerating these opportunities. To take advantage of a special TTF community discount, go to teachingtaxflow.com/reps, R-E-P-S, and use the code IFG. Better yet, click on the link below in this episode's show notes to go directly to the Reps Tracker sign-up page.
Hey everyone, John Tripolsky here from Teaching Tax Flow, joined by my counterpart, Chris Picciurro. How's it going, buddy? How are you today?
It's going great. How are you doing?
I'm doing good, man. I'm feeling acey. Feeling like I've got an ace in our hole. So
yeah.
I had to pull out some jokes here. As everybody knows,
Hopefully
you're listening
this podcast, right?
Oh, dude, that one wins. You win, sir. Here you are if you're watching it. I am bowing to your greatness. And as we get into these, this is our second part of our 3-part series. So we're looking at Schedule
Correct.
C as far as for 1040s. So if you're not familiar with Schedule A, the A in ACE, go back to our last episode, 122, and listen to that one or watch it. It's on YouTube. Go take some time, watch through it, listen to it, tell the wife or the husband or the business partner that you're doing some research. So it's the let's say it's relationship deductible, I guess, or a reasonable excuse why you can't do the dishes. So go ahead, flip it on, learn something. Let's jump into this, Chris. Let's look at Form 1040 Schedule C,
Right.
as it comes to our
Schedule
federal
C.
returns.
Well, and exactly. So we're in part 2 of our 3-part ACE series. Between Schedule A, Schedule C, Schedule E, that makes up well over 50% of the people in our teaching tax law community file at least one of these forms. So we wanted to really dive into these forms, especially this time of year. We are in the heavy tax compliance time of the year. So Schedule C. What Schedule C is, this is where you report your profit and loss for a business if you're taxed as a sole proprietor. Now, before I jump into that, I want everyone to understand, if you are a single member LLC, right, you are a sole proprietor because a single member LLC is a disregarded entity for federal tax purposes. Now, if you own rental property in a single member LLC, then you go to Schedule E, and guess what? Listen to this episode and then come back next week for the Schedule E. There are some caveats, if you've made an S or C Corp election, but that's probably the number one question for people that form an LLC. They think that, hey, I'm Johnny T LLC now instead of Johnny T, sole proprietor. That's okay. Great. Congratulations. You still file a Schedule C. And at the top of Schedule C, you're going to put your name as the proprietor, your address, but then a business name. So if it's John Tripolsky is the proprietor and you create Johnny T LLC, on Schedule C, you're going to put your name, your social security number, Johnny T LLC, and then the federal identification number for Johnny T LLC. The other thing you're going to report, and then we're going to dive into the numbers, a couple of very, very important things. One, were you required to issue 1099s, right? This is an enforcement area for the IRS. You have to answer yes or no. The other thing is, what is your code? SIC code, sector industry code. That's very, very important because many audits are based on whatever industry you're in. It's a 6-digit code and the parameters of that industry. So for instance, John, if you are a CPA firm, right? You're a CPA self-employed, and you report a bunch of cost of goods sold, you put that might trigger an audit because, why would a CPA firm have cost of goods sold? We're not selling a product, right? So make sure you have the appropriate code. Don't be lazy and just put 6 nines in, because those are the little things that go beyond the numbers that could trigger an IRS examination.
And actually, I don't think we've ever brought that up on a podcast before. And we've divin in. Oh, here I go making up words again. We've dove into some potential triggering areas with an audit. So that's a good one. So thanks for bringing that up. I don't think we've touched on that before. We have done 123 of these episodes.
I
at the end of
know.
the day.
No, I don't think we did. I mean, we've talked about the IRS data book. We've talked about a bunch of IRS representation issues, but I don't think we've ever talked about it. So who needs to file an LLC? Or who needs to file an LLC? Oh my goodness. I
There
get
you
so
go. See,
frail about F
I'm
corps
making
and
up words. You're
LLCs,
making
right?
up processes.
So who needs to file a Schedule C, right? I mentioned single member LLCs that are treated as disregarded entities, independent contractors that, especially if you received a 1099, sole proprietors, gig economy workers. So our friend, we have a soft spot in our heart for those Uber and Lyft drivers, and then freelancers. So writers, consultants, designers, all those people file a Schedule C. You mentioned it, John. Schedule C is not a separate tax return you file. It gets attached to someone's Form 1040, and we know that 1040 is a personal tax return. So let's dive in.
Basically a Lego. We're talking about Legos here. You can't build a house without the roof or something. So it just piles it on.
You're piling on. So the Schedule C's got 5 parts, right? The first part is where you report your income. That's really straightforward. Whatever your gross receipts or sales are, you're going to put on that Schedule C, Part 1. And then under that, you're going to report your returns and allowances. So, we've got clients that run Amazon businesses, right? They're retailers. They sell things over Amazon. They sell things online. And for those people, it kind of ties into that sector industry code. That code. They are definitely going to have returns and allowances. That would be reported on Part 1 of Schedule C. And you're also going to calculate your cost of goods sold and report that on Part 1 of Schedule C. But we're going to put a pin in that right now because cost of goods sold is a whole other nother part that we're going to talk about. So Part 1, you're going to report your gross income. That's anything that has been constructively received by you during the year, and you're going to net that against your returns and allowances and your cost of goods sold. Part 2 is where you put many of your expenses. Now, there are a couple expenses that have their own part. Those expenses are going to be your information about your vehicle and then other expenses. But Part 2 is where all of your expenses go. When you're looking at Schedule E, many common expenses have their own special line. And when we think about that, just from a tax preparation standpoint, that doesn't mean you have to have something to put in all of these lines. However, thinking about yourself reporting your income statement to the IRS, these are the common lines that they're probably taking a look at and determining, does the percentage of sales make sense? Does it seem out of whack? So your common expenses like advertising, commissions, contract labor, insurance, payroll, office expenses, taxes, supplies, repairs, maintenance, utilities, legal and professional expenses, all of that gets reported on Part 2. Now, in Part 2, you also report your car and truck expense, but that has a whole separate section part that we're going to talk about. So any of your common expenses or any of your expenses get reported on Part 2. And remember, what's deductible? There are two requirements that have to be met for an expenditure to be deductible. And that is 1, it's ordinary for your line of business, and 2, it's necessary for your line of business. So ordinary and necessary expenses are deductible on Part 2 of Schedule C. And it's very, very important that we take as many deductions as we can, because whatever your net income is on Schedule C is not only subject to federal tax and state tax if you're in a taxable state and local, you also pay something called self-employment tax on it. Self-employment tax is 15.3% of your net income. Now, once you get to over like $180,000 of net self-employment income or W-2 wages, you start phasing out of you hit your Social Security cap. But the point is, every deduction is very, very valuable. Now, that's self-employment tax, which this form leads to that calculation. John, so if you're an employer and I'm an employee, I've got my own business, but I'm also an employee, There's a couple things I do, and as far as teaching and that sort of stuff, that I receive a W-2 for. For that work, I'm paid on a W-2, and I have to pay 7.65% of my wages into the Social Security and Medicare system. My employer matches that. That combination is 15.3%. But if you're self-employed, you have to pay all 15.3% on your own. And that's why making sure you get as many legal and ethical expenses on this Schedule C will lead you to paying the least amount of tax possible.
And to add on to that too, called icing on the cake if we want to, we did a great podcast on kind of self-employed 101, I believe, or, multiple podcasts we've mentioned it. And if anybody's listening to this that hasn't been, let's say, filing appropriately or didn't quite have the understanding of that, a business deduction does not mean that the expense or the purchase is free. Just because something is deductible does not mean that it's free. And I'll say that one more time. Because it is deductible does not mean that it's free. Because I still hear that with people, some of my contacts and colleagues in the past, they always thought that. They're like, "Oh, don't worry about it. It's free."
Right.
It's like, no, it's discounted
I mean,
at the
even
least.
if you're at a 40% marginal tax rate, John, yeah, I hear it all the time. Oh, should I go buy a new copier? I don't know. Do you need a new copier? If you don't need one, why are you going to spend $1,000 on a copier to save $400? You're still minus $600. Yeah, that drives me a little batty.
And then I
You
imagine
got
too
me
that
upset about on the S Corp podcast, John. I've got to cool my jets again.
I had to find something to poke you a little bit, right?
Oh,
And
man.
I imagine out of everything that's under that second part on this Schedule C into the expenses, right? I believe that everything on there's pretty cut and dry, car and truck. So your auto is pretty cut and dry, except for, and this is ironic that, I'm in the marketing world and have been for a while. I feel like a lot of stuff is probably misappropriated or categorized under advertising. Because I'm sure some people just kind of use that as almost like a miscellaneous, where they're like, "Oh, I can put it under that, so throw it in there."
Well, there could be. I mean, as long as you're categorizing things in a reasonable way, I mean, you could look at. I'll give you an example. Let's say you leased a copier. I don't know why I'm thinking about. I haven't owned a copier in forever, but let's say you leased a copier, right? There's a line that says rent or lease of other business property, but there's also a line that says office expense. I don't think either of those are incorrect.
Right.
Technically, it probably should go into lease of business property. But if you were examined, I don't think the IRS is going to throw a fit if you put it into office expense.
Right, because at least it's in there. It's more the category, right?
Yes. And the one thing I want to point out in part 2 is the home office deduction. Remember, if you take the simplified home office deduction, you just fill out the bottom part of part 2 on Schedule C. But if you take the actual expense, you file what's called a Form 8829. The point is, don't be afraid of your home office deduction. This home office deduction would be very, very valuable because remember, commuting miles are not deductible, okay? But, so John, if I don't claim a home office deduction and I go visit a client somewhere and I drive 40 miles, and then I go to client number 2 and drive 10 miles to that client, and then another 30 miles home, my only deductible mileage are 10 miles because my first trip was commute, go to the second stop, that's mileage. The third trip is commute back. But if I have a home office, remember, it's got to be for home office, it's got to be exclusive use and in your primary place of business. If I don't take the home office, if I was taking the home office deduction, then my entire trip is now deductible. Especially when you're looking at that automobile expense, you're looking at percentage of miles. This could be a big, big number. So the point is this, and we're going to get into another part about auto expense. If you have an eligible home office, please take that deduction. You can talk to your tax professional about which one you should go, simplified or actual, but just take it and report that on part number 2.
And not to make this the home office episode, because we do have a bunch of them that we've talked about. I think one specifically that we only talked about home office. I'm sure some people are thinking about this. So can you have a physical location, say you're in manufacturing or even just a professional office, and also have a home office? How does that work?
Absolutely. Absolutely, you can. Remember, there's 2 qualifications for home office. One, it has to be exclusive use. So the space you're using for home office, exclusive use. Two, it has to be your primary place of business. It doesn't have to be your only place of business. So what if I had a manufacturing facility in another state and I work primarily from home? I conduct my meetings here virtually. I do all of my accounting and strategy and work here. This is my primary place of business. There might be an office. Let's say I own a manufacturing facility down in Alabama. There might be a place that I could put my stuff there when I'm there, but I'm here 90% of the time. This is my primary place of business.
Awesome. No, it makes sense. Awesome.
So part 3 is going to be cost of goods sold. Now, so people in the service industry don't tingle with cost of goods sold, but cost of goods sold could be very complicated. So if you are selling inventory or you manufacture things, it can get tricky. That is reported on part 3. And I'm not going to walk through the entire cost of goods sold or COGS calculation. Here's what I want you to understand if you're listening to this. In your mind, you deduct the cost of your products when you sell the product, right? You might be a cash basis taxpayer, but for cost of goods sold in general, you're accrual base. So you deduct the cost of so if at the end of the year, you have a $500,000 of profit, right? And you say, you know what? I'm trying to get rid of my profit. I didn't listen to Teaching Tax Law. I didn't listen to any of the 1-minute tips about what's in your bank account as your profit. And I completely ignored everything these good people are saying. So I'm going to go buy $500,000 worth of inventory, make sure I get it dropped in my facility by the end of the year. And guess what? Now I have $0 in my bank account. So voila, I don't have a profit. No. That inventory that you purchased at the end of the year and did not sell is not deductible in that year. So now you're stuck with zero cash, a $500,000 profit, and you probably owe $150,000 of tax on the profit. You don't have any cash to pay it. So think about this. Inventory is deductible when you sell it. And you have to calculate that by knowing what your beginning inventory is at the beginning, and then knowing where your ending inventory is and what your purchases are during the year. Now, we're going to move on to part 4 because, John, I don't have a blood pressure problem, knock on wood. But when I start talking about dumb things I shouldn't say, miscalculations that taxpayers make because of not planning, it gets me a little fired up. Yeah.
That and sometimes I think I'm pretty good at raising your blood pressure up. Maybe that, what a great show that would be, where we hook you up to a monitor and I just like hammer you with questions that I know are hot topics for you and just watch it change on the screen. And we could call it how to piss off your CPA or something. So
I don't know. We might have to do, we might be doing some we haven't even talked about this that much, but we might be doing some on-site live episodes. We've got some huge conferences lined up this year. If we do the blood pressure one, John, we might have to do that in Vegas, and I might have to sedate myself with some wine or something. I don't know.
There you go. Could
we'll
be fun.
To see, right? So part 4 out of 5 is information about your vehicle. Why in the heck with the IRS? John, I'm going to ask you this. I'm going to turn the tables because you like to put me on the spot. Why would the IRS create a whole separate part on a Schedule C for information about your vehicle?
Most likely it's going to be going off of what you were talking about earlier about commuting mileage, I'm going to assume, business use. So basically my guess is that they're going to want to make sure that what you're claiming is as accurate as it can be, I imagine.
No, that's a good answer. Right, exactly. There's been a lot of abuse for automobile and truck expense. So whenever there's the abuse and people taking deductions they shouldn't, the IRS says, I want more details. So yes, there's a separate section in part 4 where you have to let the IRS know when you put the vehicle into service, your total miles, your commuting miles, your business miles. You answer some questions. Was this available for personal use during off-duty hours? Did you or your spouse have another vehicle for personal use? Do you have evidence to support your deduction, aka a mileage log? Is the evidence written? So those are things the IRS are asking. So think about this. If you put on this form that you have a business vehicle, 100% business use, and you answer the question, was your vehicle available for personal use during off-duty hours? And the answer is yes. And then the next question, do you or your spouse have another vehicle available for personal use? And the answer is no. Do you think you're going to get audited? And that's
You
what
might
we're
as well
saying.
walk into an IRS office yourself with a flag that says, "I'm here, question me."
So this is where we know with automobile expense, you could take the standard mileage deduction, you could actual expense. When you take actual expense, maybe you're eligible for bonus depreciation or Section 179 that goes beyond the scope of this podcast episode. My point is, that's where the value of working with a tax professional comes in. It's not just about the numbers when you prepare a tax return. There's a lot of other information involved, right? And that information could, and I'm not necessarily afraid of an audit, but you just don't want to go through it. You could be innocently triggering an audit, and think about it like, body mass index. Like if I told you, John, hey, this guy's 6 foot tall, 220 pounds. That doesn't tell me much. Now, if the guy's 6 foot, 220, and he's in the NFL with, 7% body fat, he's going to look a lot different than a guy that's 6 foot, 220 and has very thin legs and arms and 30% body fat. Right. So you got to, the Schedule C could look, the point is, now I feel like I got to go back to the gym other than that. But the point is, it goes beyond the numbers when you're preparing
Right.
a Schedule C. Schedule C is one of the most audited forms. And it does. Again, I'm not saying everyone quit your job and go work somewhere. I'm just saying be cognizant if you're self-preparing or working with a tax professional on what's going on Schedule C.
And really, Chris, so I opened up, in front of me here, I was just looking at it as well too, that Schedule C, and you're right there. I mean, you're probably talking a third of a page is just that part 4, just on the vehicle. So be very cognizant when you approach that. And you're right. I wouldn't say they're trying to catch you in a line of BS, but they pretty much are, and rightfully so, right? Like I can imagine this is, when I was talking earlier about the advertising category, is being a potentially abused one. I think this vehicle one probably far outweighs that. So
I would agree. Part 5, a lot less heavy lifting than the vehicle. Part 5 is just other expenses. So if it's an expense that you have, excuse me, that is maybe more unique to your business, that's not in one of the categories that's already in part 2, you just put it in part 5, and that flows onto the first page of Schedule C. So there are several expenses that I'll give you an example, just one example, because of time. Continuing education. Continuing education is definitely an expense that we incur as a CPA firm. Not every profession has continuing education, so it doesn't warrant there being a separate line on Schedule C for that, but that would fall into Part 5 as something that I would report as absolutely a qualified business expense.
makes total sense. Well, that's a great way to get us kind of wrapping up here. And really, I mean, what are some other things you may want to add this? Are there any keynotes that you might want to toss in here? I know you mentioned, that Schedule C is one of the most high, oh my gosh, now I can't even speak, a higher likelihood of an audit
Of an
kind of
exam,
comes from
right,
that Schedule
yes.
C. So even maybe give us a little preview of what we might be looking for on that Schedule E.
So yeah, definitely, if you have a business, even if you're a sole proprietor, here's some tips. Create a separate bank account to keep track of your income and deductions, because once you're commingling personal expenses and business expenses, it gets real messy. You could misstate something. You could miss deductions. You could be overstating your income. You could be understating your income. So definitely separate that out. Track your expenses, right? Because a lot of times, you could have expenses that you accidentally put on a personal debit card or a credit card. I'd have maybe one business credit card or debit card, and then one business bank account specifically just for your business. Be very conscientious of classifying labor. So if you are hiring people, make sure that you understand if they're properly classified as an independent contractor or employee. And then make sure you pay estimated quarterly taxes if you have a lot of self-employment income, and work with a tax professional on that, because a lot of times people, especially when that first year when they make that transition from being an employee where all your taxes are withheld out of your pay, to being self-employed, it comes as a big surprise.
Awesome. It's a great way to close it out. I appreciate it as always.
My pleasure, and we'll see everyone in part 3.
I was waiting for you to say we will see you next week, but I figured all the jokes have sailed. Schedule C, get it? But thank you everybody again for joining us here on episode 123 of the Teaching Tax Flow podcast. Next week, as I mentioned before, we are jumping into part 3 of 3, wrapping up our A series as we look at Schedule E. So again, that last one of the series, and then we continue, we'll call it our regularly scheduled program. I know we got some great topics lined up, but I know we mentioned on all the podcasts. Be sure to check out defeatingtaxes.com. That's our private Facebook group. Tons of information and individuals in there. You won't always hear from us. You'll hear from other tax pros. But then also, if you're not watching this on YouTube, you're missing out. You're missing out on Chris's wig that he's wearing today. It's very long, and it's a very, very good-looking wig there, sir. So if you're not watching it, you know exactly, or I should say if you are watching this, you know exactly what I'm talking about. So get on and listen if you're not. And we'll see everybody back here next week on the show. Same day of the week, different time, completely different topic. Have a great week, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.